Imagine planting a money tree. What if I told you there are 3 different ways to plant it? Some faster, some safer, some just easier to manage. What are these 3 ways? Stocks, index funds, and ETFs. Today, we're going to explain exactly how each works, how they're different, and which one might be best for growing your money. Let's start with stocks. A stock is a small piece of a company. When you buy a stock, you're buying part of that company. If the company grows and makes more money, your stock usually becomes more valuable, and you might even get a small payment called a dividend. But if the company struggles, your stock can lose value. Let's look at Apple. If you had bought Apple stock 10 years ago in 2015, you would have paid about $30 per share. In 2025, that same stock is worth around $180. That's a 500% return. Not bad, right? But stocks can also go the other way. Peloton went public in 2019 at about $29 a share. By 2021, it hit over $160. Then it crashed. In 2025, it's around $4. That's a huge drop. So, stocks can be exciting and rewarding, but also risky. If you're new, should you really jump straight into individual stocks? Now let's talk about index funds. An index fund is a type of investment that aims to copy the performance of a group of companies. Think of it like a giant backpack that holds tiny pieces of many companies, all picked to match a list or index, like the top 500 big companies in the US. When you put money in an index fund, it spreads your money across all those companies. That way, if one company does badly, the others can help balance it out. It's a low-fee, simple, and safe way to grow your money over time, especially for beginners. The most famous index fund is based on the S&P 500. This includes 500 of the biggest companies in the US, like Apple, Amazon, Microsoft, and Google. The Vanguard 500 Index Fund follows the S&P 500. Over the last 10 years, the S&P 500 has returned about 10% per year on average, not including inflation. That means if you invested $1,000 10 years ago, you'd have around $2,600 today. Consider Scott, who invests $100 each month into an S&P 500 index fund. With an average historical return of about 10% annually after 30 years, Scott would have roughly $200,000. Index funds are great if you want to invest long-term and don't want to pick individual companies. They spread the risk because you're not depending on one company, you're betting on a whole group. Quick question, would you rather bet on one horse or the whole race? That's the idea behind index funds and ETFs. Instead of guessing the winner, you invest in all the big players and let time do the work. Now let's keep going and talk about ETFs. Think of an ETF as a mix between a stock and an index fund. You get the safety of owning many companies, but the flexibility of trading whenever you want. It lets you invest in many companies at once, helping spread risk. ETFs also often follow an index, like the S&P 500, and usually have low fees. Think of it like a big toy box filled with lots of different toys, but instead of toys, it holds pieces of many companies. When you buy one ETF, it's like getting a small piece of all those companies at once. You can buy and sell it easily, just like a regular stock. It helps you not put all your money in one place, which is safer. The SPDR S&P 500 ETF is one of the most popular ETFs in the world. It tracks the S&P 500, just like VOO, but you can trade it like Apple stock. Over the past 10 years, SPY has had about the same return, around 10% per year. There are ETFs for everything now: technology, healthcare, energy, even green energy. Popular ETFs include Vanguard Total Stock Market ETF and the iShares Core S&P 500 ETF, offering broad market exposure at low cost. Let's look at how these investments have done over time. The S&P 500, tracked by both SPY and VOO, has returned about 10% per year over the last 50 years. That includes big crashes like 2008 and 2020. The NASDAQ 100 ETF has returned around 13% per year over the last decade, with big tech names like Apple, Amazon, and Nvidia. Individual stocks vary wildly. Apple returned over 500% in the past decade. Tesla shot up over 1,000%, but also dropped over 60% in a single year. That's why many people like to go with index funds or ETFs. They're built to be safer and steadier. Okay, let's talk about what these three have in common. All three are investments. You buy them to grow your money. You can make money if the price goes up over time. You can lose money if the price goes down. You can buy and sell them through a brokerage like Fidelity, Vanguard, Schwab, or Robinhood. All three can be held in retirement accounts like a Roth IRA or 401k. Here's where they're different. Stocks involve owning shares of just one company, making them high risk but potentially high reward. You can trade stocks anytime during market hours, and while they're easy to buy and sell, they require careful study and understanding to be successful. Index funds let you own many companies at once, significantly lowering your risk because your investment is spread out. However, you can typically only buy or sell them once per day, and they have relatively low fees. This makes them ideal for beginners looking for steady growth with minimal maintenance. ETFs are also diversified just like index funds, so they carry lower risk. But ETFs have the added advantage of being tradable throughout the day like stocks. They typically have very low fees and provide a great mix of flexibility and security, making them another solid option for beginners. Would you rather put all your eggs in one basket or spread your eggs across 500 baskets? That's why index funds and ETFs are often safer for long-term investors. Are you still a little confused when to use each one? Don't worry, here's a quick and simple recap. Stocks, if you believe in a company, understand the risks, and are okay with ups and downs. Index funds, if you want slow, steady growth and don't want to think about it too much. ETFs, if you like flexibility, low fees, and the ability to buy and sell whenever you want. So how do you actually get started investing? First, choose a reliable platform, like Fidelity, Vanguard, or Robinhood. Fidelity and Vanguard offer extensive options for buying index funds and ETFs with very low or no fees. Robinhood is user-friendly, making buying individual stocks easy for beginners. Next, open an account, deposit some money, and select your investments. You might start by consistently investing a fixed amount monthly, $50, $100, or whatever you can afford. As your confidence and knowledge grow, you can diversify into individual stocks or specialized ETFs. The most crucial step is getting started and remaining consistent. At the end of the day, investing is about building wealth over time, not getting rich overnight. You don't need to be an expert. You just need to get started, stay consistent, and let your money grow. Stocks can give big wins or big losses. Index funds and ETFs let you own many companies at once and reduce your risk. And that's how your money tree grows, with patience, not luck. If you found this video helpful, like and subscribe to watch more videos about simplifying personal finance.